Why internal analysis? Why are we dealing with internal analysis here, the inner workings of a firm? Well, I believe that the answer is that industry analysis is incomplete. We have spent a good portion of the time of the first part of the course dealing with industry analysis. And industry analysis is important, but it is incomplete in the following ways. It doesn't explain the profit variation across companies within a market or industry. It only explains differences between markets and industries in their overall profitability of a market or industry. It doesn't explain the profit variation within a market or industry across the companies competing in that market or industry. And that variation in profit within a market or industry is often bigger than the variation that occurs between markets or industries. And the profit variation within a market or industry can only be explained by differences between direct competitors, companies that are competing against each other in their markets. And since direct competitors share the same industry environment, it necessarily follows that the differences that can explain the profit variation within the market or industry are necessarily internal in nature. They necessarily have to do with how things are done differently at different firms, such as their different resources and capabilities. In order to make this point more concretely, let's take a look at some actual statistics. These figures show the overall average profitability of the companies in a wide range of industries from over a 20-year period. And you can see it broken out by industry. What was the average profitability of companies competing in that industry over this 20-year period? And so you can see from this table that there is a wide variation across industries in the degree of profitability of those industries, the overall average profitability of the companies competing in those industries. And so the statistics and the figures that you see here on this table, those are the sort of statistics and figures that industry analysis is designed to explain. These inter-industry differences in profitability rates, that's what industry analysis is focused on explaining. And there is a wide variation there to be explained. But in order to get at the question of variation of profits within an industry, let's take a look within the top performing industry on this table, pharmaceuticals, and also the performance within the bottom performing industry on this table, iron and steel. So we're going to compare what's going on in pharmaceuticals up at the top of the chart and what's going on in iron and steel down at the bottom of the chart to get a more fine-grained view. And here is that more fine-grained view. As you can see, in the pharmaceutical industry, the average profitability rate is high. But there is still quite a wide range of variation within the industry. You have numbers here from 7% all the way up to 19%. And now look down at the iron and steel industry over this same period. Here again, you see quite a wide range of profitability, ranging from minus 3% all the way up to 12%. And so I think the point I want to make here is that although there is just as wide a range, from 19 down to 7 is a difference of 12 percentage points, from 12 down to minus 3 is a difference of 15 percentage points, roughly the same range of variation in both industries. However, what I'd like to point out here is that the best performing iron and steel companies are outperforming the worst performing pharmaceutical industries during this time period. So what does this tell us? This tells us that although industry analysis is important in helping us to gauge the overall average attractiveness of an industry, it doesn't tell you everything there is to know. And merely by being a pharmaceutical industry player, that does not necessarily guarantee you outstanding profits. In fact, there are some companies in that worst performing industry that outperform some of the companies in the best performing industry. And so what this tells us is that industry isn't everything. Merely being in the pharmaceutical industry or the iron and steel industry doesn't necessarily determine by itself whether you have high, average, mediocre, or awful profitability. Now, recall from earlier in the course, I showed you this pie chart, which basically decomposes the variation in profit rates for business units of diversified companies into a variety of effects. And recall again that the business unit effect and the corporate parent effect basically capture internal effects. They are basically capturing the effect of internal operations of the company, whether at the business unit level or the corporate parent level. The external effects are captured by the industry effect and the year effect. The year effect because, the industry effect is obvious because, as we've been saying, industry analysis counts for something. Being in a particular industry could determine a large part of your profit rates. In fact, here it says that basically 19% of the variation in profit rates is accounted for by industry. But what about the year effect? The year effect captures, in effect, the macroeconomic cycle. What is it? What is the impact of being at this point in the macroeconomic cycle on all companies overall? And so the point here is that when you combine the 32% and the 4% for the business unit and corporate parent effects to get the combined internal effect, and compare that to the combined external effect, the 2% for the year and 19% for the industry, very clearly, external factors, account for less than the internal factors, right? I'm not saying that the external factors are unimportant. Clearly, they are important. In fact, one of the things that this study by McGann and Porter shows is that both are important, both external factors and internal factors. And that's something really important to remember. However, this study and others like it show that the internal factors are about 50% more important than the external factors, because that 32% plus the 4% is about 50% larger than the 2% plus the 9%. So this study tells us that internal analysis is really important. In fact, is more important than external analysis.